Hey everybody, hope everyone's doing well and had a good day. This is the Emini review for Thursday, July 11th, 2024. And a couple things. Coming into the day, look at the daily chart first. And the market's been in a tight bull channel, but it's possible we have 3 pushes up. I can't get that exactly how I want it, but the point is 1, 2, 3 pushes up. We have this micro channel up to yesterday, and we had that really strong bull trend day yesterday. But the problem with it is the context. And when we look at the daily chart, we can see it's a possible climactic end of a move. What it could be is a buy vacuum test of resistance, like this channel line, or maybe some sort of measured move. Even if you didn't see this channel line, one problem with it, we have a bull micro channel, and these bars are pretty good, uniform in size, closing near their highs. But then we had these smaller bars, a doji, the momentum starts to disappear, and we're getting further from the moving average. And then all of a sudden we get this big bar. It looks really strong. It's shaved. That's parabolic in nature. And that's a warning that this could be a climactic end of the move. Whenever you get a really strong bar late in a move, you always have to be wondering if it's possibly the climactic end of the move, and it could lead to a climactic reversal. So I thought coming into the day that at a minimum, the bulls would be disappointed. As for the 5-minute chart today, like I said, really strong bull trend day yesterday, but coming into the day, we had this 2-bar bull breakout, 76, 77 yesterday. Really good pair of bull bars, but it's the exact same concept I was just explaining on the daily chart. Whenever you get the strongest part of the move late in the move, so at this point we're already well into a bull trend, at least 30 bars, and then you get the 2 strongest, biggest bull bars late in the trend, that's always a warning, and it's a little suspicious that it could be a climactic end of the trend. It could be an exhaustion gap. And so one of the targets, we have a breakout point, the 76, 75 high, the bottom of the buy climax. And coming into the day, let me just draw yesterday's high as well. I figured yesterday's high would be resistance and there'd be sellers above. So we'll make that blue. So bar 1, we had a small gap up. Remember, after this strong rally, but the context was bad, it's a possible exhaustion gap. And then we rallied up to the high of 78, and then pulled back, and we're rallying again on bar 1. So bar 1's a possible double top with bar 78. Bar 1, not a strong sell signal bar. There's probably more buyers below bar 1 for a scalp. And the high of yesterday is so close, we're probably going to get there and see what's there. By the way, let me just mention one more thing before we get into it. It's always good to look at the Globex chart just to have an idea of what was happening in the overnight session. And so coming into the day, here's 9:15, 9:30, somewhere in this area is where we are coming into the day. We had that strong rally yesterday, and then a lot of sideways bars, a really tight trading range. Whenever the market goes sideways for more than 20 bars, the breakout probability, directional probability, gets back in balance. It becomes more 50-50 again, rather than being on the bull side in this case. So we go sideways in a tight trading range. We have this huge bull breakout attempt around 8:45, and then an immediate reversal on the next bar, a big 2-bar reversal. So tight trading range, bull breakout attempt, that failed. That's the information we have coming into the day today. We also know that there's a 90% chance the market breaks out of either the high or the low of the Globex range. That's what these red lines are. And this is where the market's opening. And we're obviously a lot closer to the low. And based on what just happened, we rallied and then reversed pretty strongly. There's probably a greater chance of a bear breakout attempt than a bull breakout attempt of the Globex range. So that's good to know coming into the day. And you combine that with the daily chart context, and you might have a little bit of a bearish bias coming into the day today. So bar 1, not a very strong sell signal bar, but also not a strong buy. There's probably more sellers above. And I think there are probably more sellers above yesterday's high. Inside bar on bar 2, the market's getting squeezed. It's a triangle on a smaller time frame. You can see the triangle on this chart. We're getting higher lows and lower highs. The market's in breakout mode, and there's a 50% chance that the first breakout of a triangle is in the wrong direction and that it will reverse. Triangles, in this case, we have a really tight triangle, which is a tight trading range. Trading ranges are areas of agreement. The bulls and bears are both initiating trades. And so the apex of the triangle, which is the middle, roughly the middle of the triangle, will typically act as a magnet. The market found fair value there, so if it breaks out, it's going to try to come back. So here's our triangle. Outside up on 3, we had a bear breakout attempt of the triangle and then a bull breakout attempt. Bar 3, as strong of a bar as it looks, it's really not closing all that far above yesterday's high. So the bulls, it's a small breakout, but they still need follow through. Preferably another bar like bar 3 on bar 4, a big strong bull bar closing somewhere up here. Let me adjust this. Preferably somewhere way up here. But the bulls, at a minimum, want the absence of a bear body. Outside up, that damages the bull case because outside bars are trading range bars. So there's an increased chance there are sellers above bar 3. Also bar 3, think about the market cycle and the leg count. It looks like we have a breakout here, a pullback, maybe a channel phase, the start of a channel up. And bar 3 could be a second leg up, leg 1, pullback, leg 2. It could also be a nested 2 legs with the gap up and the rally on 1. Then we pulled back and went sideways and then rallied on bar 3, leg 2. So probably more sellers above 3. And then bar 4, it looks like we went above bar 3. The high is 92 even and then 92 and a quarter on the next bar. So bar 4 did trigger the stop order bulls on bar 3 and they immediately got trapped. So think about if you bought above bar 3 or on the close of bar 3. Bar 4 is a really disappointing entry bar. So what are those bulls going to do? If they're lucky enough to get a retest of their high close, the bar 3 close, or even above the high of bar 3, those bulls will probably look to exit their longs and look to buy lower. The bears, they have a stop order sell set up below bar 4, but one of the problems with it is that bar 3 itself is strong enough for at least a small second leg up. It was enough of a surprise. It was outside up. You have trapped bears below. So if we test maybe the apex of the triangle, you can see we're testing the bear trend line of it. Maybe we find support here and then rally for a small second leg. And the market tested the apex of the triangle and then bounced. And look at the tail on bar 5. Can you see what happened on bar 5? On the close of 4, we then had a little bit to the downside, and then the market rallied up to the close of bar 3. It didn't quite get there. The close was 91 3/4, and the high here is 91 1/2. So it's one tick shy of the high close of bar 3. You have bulls so disappointed who bought the close of 3 and they get bar 4, they'll use any rally they can get to exit, and that's what's happening on bar 5. Bar 5, there's probably more sellers above with the disappointed bulls. But the bears, there's not that much selling pressure. The bears are hoping this is maybe 2 or 3 legs up. You can see it in different ways. Maybe this is the first push, the tail on 79. It's not great, but there are 3 pushes up. So maybe there was a sell below bar 4. But again, after bar 3, not ideal. And then you get this bar. As a bear, you might be disappointed. Look to buy back your short, look to sell a little bit higher. Outside up on bar 6. Now it's a more clear 3 legs up, maybe using bar 1, 3, and 6. Bar 6 is a bull bar closing on its high, so it's not the ideal bar for bears who want to be looking to sell either below or above the bar. So we may have to go a little bit higher before we find more sellers. And again, the selling pressure isn't great. There's an open gap from the open of bar 78 to the close of bar 4. So that's a sign of possibly trapped bears, and the bulls are hoping they can continue to rally and further trap the bears, forcing them to liquidate their positions at a loss, providing fuel and more fuel to send the market further to the upside. The bears, they're hoping they can sell above bar 4, scale in higher, and the market's in an overall trading range here, and they can make a profit that way. 7, we have consecutive bull bars closing on their highs. And now we have bar 7 closing fairly far above yesterday's high, but it's the first bar closing. Let me see the high of this bar, 92 and a quarter and 92 and a quarter. So bar 6 did not break out of bar 4, but now bar 7 is breaking out. But it's the similar problem with bar 3, where we have a breakout, but now we want to see follow through. And again, when you think about the market cycle and the leg count, it's more clearly 3 legs up here. And again, different ways to draw it. There's always going to be different ways to draw it. And it could even be a nested wedge where the market rallied on 5, pulled back, rallied on 6, pulled back, rallied on 7. 3 legs up, a couple different ways that you look at it. And a possible breakout attempt of yesterday's high where we're expecting more sellers above. So 7's a great bar, but we need to see more from the bulls. One more thing about bar 7 is that it's a good looking pair of bars, but it's kind of similar to what I was saying on the daily chart and with these bars, where why are we finally getting good looking bars after 3 legs up? That's a classic example of bears stepping aside, pulling their limit orders higher, looking to sell higher, and the last of the weak bulls buying. So everyone's looking to see what the follow through looks like on bar 8. And that's what we got on bar 8. Bar 8's a strong bear outside bar. For the bears, we have a low 3 short set up. And I want to say one thing about this wedge, because I've mentioned the lack of selling pressure at this point. The bears have 1 bear bar today, and there's an open gap here. Trapped bears below. But on the open, lower probability events do happen more frequently. And so this wedge has more merit than it otherwise would because it's occurring at the beginning of the day. And then you get this big bar on 8. And you combine it with everything else I've been saying with the overall context and the expectations coming into the day. Are we expecting another rally like this today and for the market to continue to rally? Probably not. And at a minimum, we're expecting sideways to down price action to begin by the start of the second hour. That's the minimum that we're expecting for today. But either way, we're not expecting a big follow-through day for the bulls. We're expecting disappointment. And now we have 3 pushes up. You can see it all sorts of different ways. And then a big bear bar closing on its low. So for me, I think bar 8's a bar that the bulls need to exit longs below. Bears will short on stop orders below bar 8. It's not a good limit order buy for the bulls because we have 3 legs up, and the market could easily come back and test the low of bar 80, which is the start of a channel. If this is a reset of the market cycle, sorry about all the lines for now. I'll get rid of these. bull breakout, pullback, channel phase, and what do we know about the market cycle? It goes breakout, channel, and then trading range. And the start of the trading range is the bottom of the channel, the bar 80 low. So we could easily come back and test this line. And the market doesn't have to stop there, because I mentioned this could be an exhaustion gap. And that means we could easily come back and test the low of bar 76. And the market doesn't have to stop there either, but we will continue with the price action. So maybe this is a target. And then bar 9, it's sort of the gold standard. It's a great bar for the bears who shorted below bar 8. We quickly tested the start of the channel, bar 80, and what does it look like? Does it look like we sold off quickly and then rallied into the close? No, there's no big tail on bar 9. Bar 9's a big, strong bear bar with small tails. Now we have consecutive bear bars, always in short. We're crossing the moving average. We had a wedge on the open. We have a target below the exhaustion gap bottom. And really there's all sorts of targets on the way up. Every pullback, you have trapped bears here, here, here. All sorts of targets on the way up yesterday. Now we have consecutive bear bars. It's a leg count reset. This is leg 1. It's a reset of the market cycle. We are expecting a second leg to the downside after such a strong breakout. And what does Al say about always in? Whenever the market flips to always in, you really should try to get into the market for any reason. And so that could even be selling the close. It might be sell the close bar 9, but I think it's important that you certainly are not long at this point, because we're probably going lower. And then of course bar 10 was a little bit of a surprise, really strong follow through for the bears. Why did we get bar 10? Well, there's a couple of reasons we may have gotten bar 10. Here's a measured move of these bars 8 and 9. Here's the measured move target. Came very close to it, and you can always adjust it, and maybe it's the bodies, maybe it's the body of one, the tail of the other. Doesn't really matter. The point is, somewhere in this area we're expecting support. So the market could bounce here. But remember, I mentioned this in yesterday's video. Measured move targets are not enough reason to take a trade in the opposite direction. So you see this, you see 3 big consecutive bear bars. Is there any reason you should be looking to buy here? I would say absolutely not. This is a clear, strong breakout and always in short. And so you are either flat or you are short. And I want to say one more thing about this breakout, because I think it's a classic example of what Al talks about with breakouts, where he says breakouts are the best opportunity for really anybody to make money. There's high momentum, the market can move a big distance, but because of the big bars, your stop has to be far, and that means your risk has to be big. And that's the importance of having 2 position sizes. You have your regular position size, and then you have another position size that's maybe half the size or a quarter of the size of your regular position. You have to have that I don't care position size, so that when the market does something like this, you're not trying to calculate your risk. Like if I sell the close of 10, put my stop up here, that's too much risk. How many points is that? That's 25 points. I can't risk 25 points. You don't want to be worried about all that. So you need to have like a backup plan for when the market does something like this. But it's just like Al talks about. It's a classic example of beginners get trapped out because the market moves quickly, the bars are big, and it's unfortunate because the probability is high. You get a 60% chance that the market falls for a measured move. And here's our target around the 60 EMA. And look to the left at this target, it's pretty interesting. And you can see my cursor lines up with it. This measured move target would be testing over here where the bears got trapped, and this was the start of the strong rally. So 60% chance the market's going to fall for a measured move. And in trading, 60% is as good as it gets. So if you're a trader, you have to trade. More follow through on bar 11. It's a strong bear breakout, and it's leg 1. Is it leg one, pullback, leg two? No, it's leg one. So we know that there's going to be a second leg to the downside. We know it's always in short, and we know that the theoretical stop is above bar 8. Traders are not going to let their stops get run above bar 8. So you don't just sell the close and walk away and then have the market form a trading range and then come back up here and stop you out. You have to manage the trade. But the theoretical stop is up here, and the market could have a deep pullback, maybe 50% pullback, and then come back and test your original entry price, maybe the bar 11 close. But the point is, this is the theoretical stop, and it's not where you're going to actually let your stop get run. So where do you actually put your stop? Some traders, they'll put their stops a measured move of a bear bar, like maybe bar 11. It's a little aggressive, kind of tight, but right here, I think at a minimum, I would put my stop above bar 10. But the problem with these stops is there are sellers above these bars. There's sellers above here, 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 and even here. But that's the utility in having a couple of position sizes, so you can just sell, use the correct stop, and not have to worry about it. Bull trend bar on 12, but probably due more to profit taking than aggressive bulls buying. You can see we're at support to the left, maybe the bottom of this channel, this trading range. But this is so much momentum to the downside that we know that bar 12 is probably a minor reversal, and there's probably more sellers above these bars, and the market's probably going to get a second leg to the downside, and we could get a measured move, which I'd actually like to keep a horizontal line down there. Yeah, we'll base it on these 4 bars. And I might be in snap mode. Yep. So turn that off. And here's the bear spike measured move. And we tested the bottom of the buy climax. We'll get rid of that line. Obviously, we can see the market rejected yesterday's high. We tried to break out above it a couple times, and that second attempt really reversed strongly. Probably sellers above 12, scaling in higher. 12 might have been a big enough bar for a small second leg, but remember, you're trading always in. You're looking for sell setups. So even if this is going to get a second leg, it's not worth trying to scalp it and make money that way. It's better to just look for the sell entry. 13 rallied higher, but then reversed and closed near its low. Maybe 3 pushes up on 11, 12, and 13, being a parabolic wedge, a climactic third push. Low 1 short below 13, and in this context, it's okay to take a low 1 after such a strong market cycle reset, a leg 1 breakout. This is a low 1 that traders will actually sell below. And then I can't tell if that's an inside bar. So we did trigger the low 1 on bar 14, not the ideal entry bar. Like bar 9 was the ideal entry bar for bears selling below 8. But what do the bulls have here? If they're lucky, maybe there's buyers at the bar 11 close, disappointed in this rally, which was a fair rally, but compared to the sell-off, not really. So you might have bears disappointed, buying back short in this area, and maybe we bounce for a small second leg. But the reality is you should not be looking to buy, and it's okay to sell the low 1 and to be short here. The market is still always in short. 15, we fell below the bar 11 close, so it looks like that wasn't support, and the market broke out to a new low, closing below all these bars to the left. Now we have a new breakout. Is this leg 1, pullback, leg 2? Yeah, this might be the start of leg 2. There is a pullback, but this probably is not the end of leg 2 because it's not symmetrical. Now we could get an even deeper pullback. Maybe this is all leg 1 and then a pullback, but yeah, this is probably not leg 1, leg 2 because the market likes symmetry. And this breakout was so big and strong, it's probably going to get a bigger reaction than just 3 bars. I've talked before about event and response, and that's a concept I picked up from Ali. And if you think about it, the market, you can think of everything as cause and effect. or event and response. And in this case, we have a defining characteristic, a major event of the day, which is this bear breakout. And so that's your event. And here's a response. It's a minor response. It's a minor pullback. But again, we're still expecting a big second leg and probably a measured move down to here. So that's the response that we are expecting and looking for. 16, we have another bar that's probably due to profit taking. It's a bull doji. What about buying above 16? Maybe it's a wedge bottom. You cannot buy above 16, and the problem is that it's a minor reversal. The first thing you need when you're trading counter trend is a trend line break. Isn't this a trend line break? Yeah, traders will argue that this was a trend line break, but now we're getting a lower low. We've had 2 bull bars in however many bars, maybe almost 10 bars. Only 2 bull bars. One of them's a doji. There's probably more sellers above 16. Every reversal attempt is likely going to fail. 80% of breakout attempts, or rather reversal attempts in trends, fail. So in this case, we have a bear trend. We're expecting more to the downside. It's better to look to sell double bottoms. So if you want to argue this is a wedge or double bottom, better to look to sell above 16. And then we went outside down on 17. So it's an outside bar. The market's expanding its range, and it's an expanding triangle, probably sellers above 17. But because of the context, I would not buy below when we're expecting more to the downside. And then 18, if you did buy below, betting that it was an outside bar, expanding triangle, you got trapped on 18. Bar 18, there's an 80% chance we've seen the high or the low of the day, and because 18 is the low of the day, and we're so far from the high with so much momentum, the odds are we've already seen the high of the day. 18, strong enough breakout, probably going at least a little bit lower. You can argue it's 3 pushes down on 11, 15 or 16, and then 18. Maybe the market will correct. Maybe it's a little parabolic, but any correction is expected to be minor. There's not enough buying pressure to be looking to buy. Follow through on 19, so bear breakout 18. Follow through, we have a micro gap. The low, or rather the high of 19 did not overlap the low of 17. We have a gap between these prices. I didn't even mention the gap earlier, and maybe I should have, but there's a pretty big gap. Think about a bull who bought below bar 7. This entire space is a gap. The market did rally up to 13, but the bulls who bought here never had a chance to get out. And I say that, but if you look at bar 9, there actually was a tail on 9. The market did rally briefly. So if you were quick enough, you did have a chance. But if you weren't quick enough, you would be experiencing a lot of pain. Maybe leg 1, leg 2, but this is all very tight. We're probably going at least a little bit lower, and this measured move is still in the back of our minds. There's also an argument to be made that you don't include bar 11. Maybe you just include the strongest bars of the breakout, like 8, 9, and 10. And so it is possible we fall short of this measured move and just make it to the one using 8 through 10. But we will see. 19, another bad buy setup. Too much selling pressure. It's a tight bear channel. It's a weak signal bar. And it's a bear trend. We're probably going lower, and reversal attempts are failing. Bull breakout on 20. So, like I said, it's a possible parabolic wedge. Maybe we get some sort of correction, and 20 could be the start of that. And 20 is a strong enough bar that we may go a little more sideways to up. But it's similar to bar 12, where I said, yeah, it might be enough for a second leg. But that second leg is expected to be minor. And you shouldn't be looking to trade in the direction of that second leg. You can count the legs and look to enter short after 1, 2, or 3 legs against the trend. But you should not be looking to buy in this context. There were probably sellers above 19, and the odds are if you sell above 19 and scale in higher, you're probably going to make money. And immediately, bar 21 reversed bar 20. And the bears who did sell here scaled in higher, they made money. Bears who even sold the close of 19 got trapped on 20, they made money. Enough sideways here that we may get a second leg up, but there's probably sellers above bar 21. Bear trend bar 22, so it's less tempting for bulls to buy below. They could have argued it's a 3-bar trading range with buying pressure, this bull bar and this tail, but now you have a bear bar closing near its low, which is less enticing for limit order bulls. Some bull might try to argue that this was strong enough for a second leg, and then we sold off, pulled back, sold off again. It's 2 legs down to the bottom of a trading range. But it's really that's me looking for the opposite argument. And the reality is we're probably going lower. This is probably a bear flag, and the odds are the bulls are going to fail, and we're going to fall for a measured move of this bear flag. And then look at bar 23. Big bear breakout, already almost getting to that measured move target. And any bull taking the buy, getting trapped to the downside here. Now this looks more like a symmetrical leg 1, pull back, leg 2, but we're probably not done with the downside. And here's the leg 1, leg 2 measurement. And look at that. We have this big bear breakout, and it was a sell vacuum of support, and it's almost a perfect leg 2 measured move. So there might be support here and some buying, similar to bar 20, but the buying is from bears taking profits. It's not so much bulls buying aggressively. But again here, maybe 3 legs down, which will also contribute to some buying pressure, consecutive sell climaxes, parabolic wedge. But we know about parabolic wedges that the reversals are minor. And so we might have a bounce here, but that's all we're expecting is a bounce, not a major reversal. I want to say one more thing now that we're up to this point in the day. Think about how much the market has sold off today. And let's actually look at it. The market sold off 0.86% in how many bars? Really less than 23 bars. And so it's less than 20 bars. The odds that the market just continues to fall at this rate is really slim. And what's more likely on days like this, and you'll see this in Al's encyclopedia, you'll see this if you conduct market studies, when the market moves so much distance in the beginning of the day, the most likely event to occur after is a trading range, and the market ends up going sideways into the close. I'm not suggesting we start going sideways right here. I know that there's still room to the downside for some measured moves. There's enough momentum. This is a parabolic wedge. But what I'm saying is that I'm not expecting this bear trend at this rate to continue all day. And the most likely event to occur is a trading range into the end of the day. And that's, again, event and response. Here's an entire event, and the response could be the rest of the day goes sideways in the trading range. The second most likely thing would be a continuation of the bear trend, although probably less steep. And then the lowest probability event would be a big bull reversal after such a strong sell-off. So here we are with a parabolic wedge testing. We're trying to break out of a channel line, testing the leg 2 measured move. A couple of reasons to expect a bounce, and that's from bears taking profits. 24, so we have a bear breakout 23. Small follow through 24. There's probably sellers above, but we could bounce all the way up and test this breakout point. 25 more sideways. This is a spike in channel on a smaller time frame. We spiked on 23, and we're channeling down on these 2 bars with small bodies, big tails, lots of overlap. This is a bear channel. There's so much overlap, it's almost a trading range, and so we could come up and test the 24 high, but if we do, there's probably sellers above. More channeling to the downside. Bears are selling in the upper half of each bar. Here we came close to the high of 24 on 25. 25, we're above the midpoint of the bar. They're selling on limit orders. Now we have an inside bar, reduces the probability for breakouts, and probably going to go more sideways soon with bears taking profits, the momentum waning. And then look at 27. that is a perfect test of the measured move that we have drawn. And it's always satisfying to see that. Like we saw the leg 2 measured move on 23, and we see the 27 low testing the spike measured move. It's always a reminder that nothing is random in trading, and it's all based on sound logic and math. So now we have 27 testing the spike measured move. We can go ahead and remove it. We know that that target has been met, and there was obviously a reaction there. We sold off on 27 and then reversed. So 27. So what about buying above 27 if it's testing support and it's 3 big legs down? Can you buy? I would not buy, because for a couple of reasons. For the first reason is that 27 is a weak buy signal bar. It's a trading range bar. Even though it's a buy reversal bar, it's a doji. So for that reason alone, there's probably more sellers above. But then, of course, the context, it's a tight bear channel. It's a micro channel since 21. So the odds are the first pullback will lead to more sellers above. But 27 was enough of a reaction at the measured move target that now there's probably buyers below 27. We rallied on 28, and we're testing high in this channel, this small channel I'm talking about, with 24 through 27. By the way, it's interesting. It's a small pattern. I'm going to keep it on this chart, but we have that bear channel. Maybe it's not perfect, but the point I'm making is that 27 broke out of the channel, and that's a low probability event. Markets tend to break out above bear channels and below bull channels. So here we have a bear channel, and then we have a breakout of the bear channel. The odds favor a reversal and then a test of the trend line. That's what we're getting on 28. But 28, are bulls excited about 28? Of course not. No one's buying above 28. There might be buyers below 28, but they may not come in until, like I said, below 27. This was a rally. Every tail is a failed breakout, and therefore there's probably a rally on a smaller time frame from the low of 27 to the close, and bulls will buy below that. Low one short below 28, not ideal. Like I said, probably buyers below, but they may not come in until down here. Then we have a bear bar 29. Bulls probably not excited to buy below it. We're probably going lower, and there's probably sellers above 29. 30, again, going a little bit lower. Bulls looking to buy lower. Bears still holding short, but they know that we've reached this important measured move target on 27, and the market had a pretty major reaction to it. We sold off exactly to it and then rallied all the way up to the bar 28 high. And that's enough of a move right there for a second leg. And again, probably buyers below. 31, we have a bear breakout attempt below 27, and it closed below 27, but we still need follow through. It's similar to these bars up here. Bar 3 needed follow through, 7 needed follow through. That's the importance of follow through. And when you don't get it, that's a problem. So the bear's hoping for follow through on 32 after the breakout on 31, but some bears might use 31 as a chance to get out at a great price. Because we know we're at a measured move target, and this rally, again, was enough of damage that bears who sold way down here on the 27 low will be disappointed, and they'll buy back shorts down here. And then we have that big bull bar 32. A little bit of a surprise, but it makes sense why we rallied. Double bottom, but context is still bad. We still don't have a bear trendline break. Here's a bear trendline. We're still within the range, and then you have a rally. So bears will sell rallies like bar 32, but 32 is strong enough for a second leg up. And the market might be starting to go more sideways here, converting into a trading range. That's the expectation at this point in the day, that the market starts to go more sideways rather than continuing to sell off. And you're getting decent buying pressure here, bar 20, and then bar 32. These are good bull bars. 33 rallied a little higher, disappointed the bulls. So any bull who bought the close of 32, disappointed with 33, they might just get out, look to buy lower. There's buyers below these bars rather than up here, because bulls aren't going to buy high in a bear channel. They're going to take profits up here. and bears will look to sell up here. But again, after such a strong bull bar, the bears might wait for a second leg up. Low one short below 33, but low probability after a strong bar 32 and a small signal bar 33. But then we got a strong entry bar 34. That's what bears need. If it's a weak signal bar, they need a strong entry bar. That's what they got on 34. But again, probably buyers below. Bears who sold the close of 31, disappointed with 32. They'll use any sell-off they can get to avoid a loss. 60% chance, bears who sold the close of 31. They did something reasonable, consecutive bear bars, micro channel. They got trapped. They scale in higher, 60% chance they can make money, 80% chance they avoid a loss by selling below a bear bar like 33, exiting at their midpoint of their two entries, which would have been reached on 34. 35, a little bit of follow through for the bears, but still within the range of 32, which is a problem because look at all the overlap since bar 24. There's a good amount of overlap here, even though the bulls only have one bar. And there is something to be said about that. This is probably not going to convert into a strong bull reversal. At least not yet. The bulls don't have the buying pressure they need. But it's enough damage. The bears, they see that the market's going more sideways. We are still creating lower highs and lower lows. But as soon as we get a higher low, we then have a bull trend and a bear trend at the same time. That's trading range. Trading range bar on 35, probably buyers below, and buyers below 32, and probably sellers above. And then 36. 36 could be the second leg for the bulls. Strong enough breakout 32, deep pullback, and then second leg. I want to just draw the disappointed bears. Bear sells the close of 31. They scale in higher, 33. And we're looking for the midpoint, the 50% between those two entries. That's this red line. And that was tested on 34. Looks like bears took it. They didn't quite get down to their sell the close entry, the close of 31, before we rallied on 36. 36, another good looking bull bar. So the buying pressure is pretty good. Bulls are getting some good looking bull bars. But the problem with 36 is now it's two legs up, high in a bear channel. Bears will sell above a bar like 36 and scale in higher. Bulls who bought 32, disappointed with the deep pullback, they'll exit on 36. So there's sellers up here. Follow through 37. It's a little bit of a surprise, but it's a smaller bar than 36, and it's a test of the moving average. Different ways to draw it. Maybe it's 3 pushes up to the moving average. Consecutive bull bars, is it always in long? No. The market at this point is either in a bear trend or a trading range. So in either case, consecutive bull bars, bears are looking to sell, bulls are going to look to take profits. This is not a scenario where you buy the close. Disappointing follow through on 38. So what about selling below 38? 2 legs up, maybe a wedge bear flag. You can, and it might be, the market's probably high in a trading range, but after these 2 bull bars, we might get a small second leg up, maybe buyers below 38, but I would not buy below 38. And as far as selling below 38, not the worst trade in the world, but there's probably more sellers above and more sellers after a second leg, sideways to up. 39 could have been that second leg for the bulls, sideways to up. We rallied on 36, 37, pulled back, rallied on 39, and then sold off on 39. Inside bar, 39, but it's closing on its low, high in a trading range. Bulls might exit below it. And that's what happened on 40. We had bulls exiting, we had bears shorting, and we had a sell vacuum test to the bottom of a trading range. I call this a sell vacuum. I wasn't calling these sell vacuums, but Al talks about it in the literature. There are all sorts of ways to describe breakouts. You can call it a spike, climax, gap, breakout. There's all these different terms, and they're used in different contexts. And there's a difference between a bar like 40 and 9 or 8, or any of these bars up here. This looks like the start of a bear move. This looks like a sell climax in the bottom of a trading range. You have a couple legs up, lots of overlap. We're not even breaking out of the bars to the left. And so there's probably more buyers below 40. Now it's a little riskier based on the context of the day, and bulls are aggressive if they're buying, but bulls will buy the new low, betting that the market's converting into a trading range. But because of the context, there is a higher chance of a bear breakout. That doesn't mean there's a 60% chance of a bear breakout. It might be a 52-48. And then disappointing follow through on 41. Not a good bar to buy above. It's a bad stop order trade, and this is all one leg, probably enough for a second leg down. We've had a couple legs up and then just one leg down. Probably sellers above 41. 42 rallied above 41 and then sold off, and 42 is a low one short. Sell signal bar, but it's a bear bar, but it has a bull body, and it's low in a trading range, or it's low in a bear channel. Actually, I would argue it's not low in a bear channel at this point, even though the market's getting lower lows, because we had a higher high here. And so maybe we have an expanding triangle, but bear trends do not get higher highs, and that's what we got here. And so the market is in a trading range at this point. Sorry, did not mean to do that. So probably buyers below 42, low one, sell signal bar. Outside down 43, it's not technical. It's a variation of an outside bar where the highs are equal and the low is lower. But outside bar could be the second leg down, leg one, pullback, leg two. Outside bar, expanding triangle, low in a trading range, triggering a low one. Low ones are better to look to buy at the bottom of trading ranges. So there's probably more buyers on the close of 43. Outside up 44, breakout mode, outside pattern. Consecutive outside bars, the market's searching for direction. And right now it's low in a trading range. And we've had 3 pushes down. Increases the chances of a bounce. And a decent bull bar, 44. 45, we triggered the buy above 44, but look at all the overlap on bar 45 with 44. Probably 80% of the bar is overlapping the prior bar. That's all trading range characteristics. This is probably not the start of a big bull trend that will rally for the rest of the day. The market's in the middle of the trading range, so if you're buying here, you're forced to buy on a stop order with big risk in the middle of the range, the worst place to buy. 46, a little more follow through, testing the moving average, but think about to the left, you have bulls who bought up here who got trapped on 40. And so when we rally, there's probably more sellers above. This is already maybe 2 or 3 legs up. Rallied on 44, pulled back 45, rallied on 45, and you could argue the rally started on one of these tails, and the market's rallying for the third leg to the moving average. And then an outside down bar, 47. Sellers above and probably buyers below. The buyers may not come in until down here, and the sellers may not come in until up here, still in the middle of the range. Inside bar 48, this could all be one leg, and then an outside bar is the pause, and 48 could be the start of a second leg to the upside. Bull bar closing on its high with room to the top of the trading range, and then instead we had a bear bar closing on its low. Inside bar, consecutive inside bars on 49, that's breakout mode and in the middle of a trading range. You can draw it several different ways. We know the market is in an expanding triangle. We know that it's also in a contracting triangle. Different ways to look at it. But either way, that tells you the market's in a trading range. And in the middle of the range, you're looking to take profits. You want to buy low, sell high, look to take profits in the middle. So the market's doing trading range things in the middle of a tight trading range. Lots of overlapping bars. Bull bar, they sell. Bear bar, probably buyers below. Follow through on 50 consecutive bear bars, but the downside is probably limited. This was all maybe one leg, then a deep pullback. Maybe we get a second leg. There's buyers below 44. Doji on 51. Might be the separation of 2 smaller legs to the downside, like leg 1, pause, leg 2, buyers below. 52, another bear bar, but it could be a second leg, and it could be nested second leg, with this being leg 1, this being leg 2, and again, leg 1, pause, leg 2, testing support below 44. Probably buyers below. Inside bar 53. It's similar to 42. It's a low one at the bottom of a trading range, and its 3 pushes down. There are probably buyers in this area, and a couple of reasons to expect support here. 54, more sideways, a couple of overlapping dojis, it's breakout mode. The market is searching for direction, and the downside is probably limited because of the context. We're low in a channel, and it might be a wedge bottom testing support. Another small doji, and it's really just breakout mode. It's a really tight trading range. It's barbed wire on a smaller time frame. Market's going very sideways. The bears are hoping it's a bear flag, and it's a bear trend here. We go sideways and break to the downside. But more likely, we'll rally. We've had a couple legs up, a couple legs down. We're probably in an overall trading range here. Bull bar 55, probably buyers below. And then 57, going a little higher. Bulls bought a pullback of the bar, did not get below, but enough to the upside for a second leg. Tight trading range here, bears got trapped, and they will provide fuel for a second leg. Another bar 58 for the bulls, probably buyers below, crossing the moving average. Good for the bulls, but not as good as it could be. And it's the first close above the moving average since bar 8. So some traders, 48 was the first close, but second close since then. So it's not as bullish as it could be. The bulls want follow through. Minimum follow through on 59. The bulls, looks like they got a bar completely above the moving average. That's a change in the market condition. That's the first time that happened since all the way up here. And so this bear trend probably over. This is probably a trading range. The market's probably going more sideways here. Strong enough leg up for buyers below. Bad low one short on 59. Pullback could be deep, but there's probably buyers below. 60, we're getting a deep pullback. Probably find buyers in this area, like the top of this tight trading range, which is where 60 is testing. More of a buy the close bar. If a trader buys the close of 60, scales it lower, they're probably going to make money. And then 61, big bull bar. Traders did buy the close of 60. Big bull bar, but possibly a second leg trap. It sort of looks like a classic second leg trap, where the second leg is big and climactic, looks stronger than the first. Here's the first, and then a big second leg. But look to the left. Last time we were here, the market sold off. Even if we go a little higher, last time we were here, market sold off. So the bulls who are trapped up here, retesting on 61, probably going to find resistance. Inside bar 62, but disappointing for the bulls. It's a high one, but it's a second leg. And this high one is different than this low one. Strong breakout. It's a reset of the market cycle. They will sell the low one. But here, high one, after a second leg up, high in a trading range. There's traders selling above 62. 63, bull bar, but basically a doji, and probably more sellers above. We're getting high in the range, a couple legs up. The upside's probably limited. Outside down 64. We've had a couple legs up. Now the bears want a couple of legs to the downside, and 64 could be the start of that. There's probably more sellers above 64. You can sell below 64, but it's an outside bar, so there might be more buyers below and a deep pullback. And then we're getting a pullback. We did not trigger below 64, but it pulled back, testing the open of 64 on 65. 65 is an inside bar, probably sellers above. There could be buyers below, but the context isn't great. Buyers below for a scalp. Consecutive inside bars, 66, probably sellers above. And again, maybe buyers below, but context isn't great. Might be 3 legs up, high in a trading range. And then 67, good looking bull bar, breaking out of a lot of bars to the left, but still not out of the trading range. That might be 3 legs up. The bulls still need follow through. They still really need a breakout above here. I'll draw that line. Here's the top of the trading range. So the bulls were still within the trading range. This could be a buy vacuum test of resistance. The upside's probably limited. And then a bad follow through bar. No follow through. The bears got a bar on 68. Now we have a possible low 3. 1, 2, 3 legs up, and it's a double top with 61 It's a higher high double top. It's a lower high double top with over here. There might be sellers below 68, but 3 consecutive bull bars. There might be a small second leg. And then 69, disappointing for the bulls. Bears who sold below, getting a decent entry bar, but still at the moving average. And the bulls had a decent amount of bars above the moving average here. Doesn't mean we'll stay above, but if we do go below, the downside's probably limited. Overall, we're in a trading range. Consecutive bear bars, sellers above 69. We triggered 69. 69 is effectively a high 1. You can even call it a high 2. It's a double bottom with 64, but a bad signal bar, sellers above for a scalp. But if you did sell above, your entry bar is not all that good. There might be buyers below 70. Inside bar going sideways on 71. It's a trading range bar. Very tight trading range here. Overall high in this range. Increased chance we come to the downside and test lower. Outside down 72, but possibly a second leg. There might be support. Buyers around here. You had bears who sold above 60 getting trapped. That's where 72 is testing. And then we rallied on 73, partially at least for that reason. Support here. We get 2 legs down. Bears buy, bulls buy for a scalp. Inside bar 73, sellers above, buyers below. And then a rally on 74. But 74 has the same problem as 61, where it's a good looking bull bar, but it's late in a move. It's probably an overall trading range. We know it's high in an overall trading range. And we know that it's not breaking out of anything. It's really within this range. So the bulls need to do more. And 74 is more of a sell to close bar. 75 bear bar closing on its low. This happens all the time. In trading ranges, you have these good looking bars. And here's a good example. Bull bar, immediate reversal. Didn't happen so much on this bar. There were probably bears selling the close, disappointed with the bar, just exited. But it happens all the time. Here's one, 2 bar reversal, 2 bar reversal. In trading ranges, the market's constantly probing up and down, getting vacuum tests of support and resistance. 75 has a better chance of going lower, so it's less of a buy the close bar because we're still in the upper third. Well, maybe we're in the middle of the range here, but overall this trading range, we could easily come back and test the bottom of the range. And maybe we'll test the 60 close. Bears got trapped on that bar. And then again, it happened, you can see on 76. Bull bar, they sell it. Bear bar, they buy it. Deep pullbacks and lots of reversals, but probably sellers above 76. We triggered the buy and then reversed down. Micro double top, but not a very good stop order trade. Very tight trading range. We could fall lower. There's probably buyers below 72. Buyers at 60 close. Buyers lower. Lots of overlap on 78. We are going lower, but the downside's probably limited. We might have 3 pushes down right here. You can look at it different ways, but it might be 3 pushes down to support. Increased chance of buyers in this area. And then you can see we sold off a little more, but found support in this area. Maybe it was the low of 60. It doesn't matter. It's somewhere in this area, and it's 3 pushes down. So we might rally there. And it's 3 legs down, looking at it this way. Maybe 2 bigger legs down. Maybe 1 pull back 2. Maybe 1 pull back 2. Maybe 3. Lots of different ways to look at it as a late leg. So support here for several reasons. Not a very good stop order, but we are testing support. We might rally a little higher, but it's bar 79 late in the day, not really worth doing much. And then we rallied above the moving average on 80, but testing resistance, probably sellers above, limited upside. And then 81, just a bear bar going more sideways. For always in today, I'm not sure if it was clearly always in the beginning of the day, the first 7 bars. I think based on yesterday's context, you see the bull trend. You can argue it's always in long, but the buy climax, 76, 77 at the end of yesterday would concern me. That was a climactic end of the move. And then we had 3 pushes up to bar 7. So I thought by the close of 7, certainly by the close of bar 8, the market's always in short. And I mean that with context, because at this point, the close of 7, we didn't have a clear as Al says it with always in, there were no consecutive bear bars closing on their lows, and that wouldn't have happened here until bar 9. And so if you look at it that way, that's also fine, the traditional way, using price action. But with context, I thought it was dangerous to be long on bar 7. Clearly always in short on bar 9. Everybody agreed, everybody sold on 10. And then at the end of the day, we did go sideways, but it never became clearly always in long. And so you could hold your short, but at some point, the market goes sideways enough that bears start to take profits at new lows. So always in short all the way through here. This wasn't enough. I said here, this was not enough. Whenever it comes close but fails, you can sell. That's enough reason. And that's what happened here. But this was enough to convert the market into a trading range. And so when that's the case, big bear bar and follow through, but low in the range. Buy low, sell high. So it might be always in short, but that's a warning to get out of shorts, maybe even buy. And then that happens all the time. Consecutive bear bars, but low in a trading range. So if it's always in short with the price action, but you're low in a range, not ideal. Big bull bar, minimum follow through, high in the range, probably not always in long, better look to sell. And then for stop order trades today, I thought selling below bar 8 was reasonable, selling below bar 9, bar 10, sell the close on these bars. You could sell below 13, low 1, always in short, sell below any bear bar, closing below its midpoint, and all the way down. And then as far as buying, maybe reasonable to buy above 45. Not ideal, forcing you to buy in the middle of a trading range, but 3 legs down, OO pattern, we could rally to up here. In this case, we did not quite get there. And then double bottom and wedge bottom, 56 you could buy above, 57 you could buy above, looking for a couple legs up in the range. But these are not swings. These are trades within trading ranges. And so stop orders are going to be limited. Let me back up. This was a low 2, maybe even a wedge. You could sell below 39 with the bear trend, maybe still in effect. And then low 2 here, II pattern, you could sell below 49. But you test the lows and there's buyers. Up here, low 3, maybe low 2, 1, 2, or 1, 2, 3. Sell below 68 for a couple legs down, but support at the 60 high. And then that would probably do it for stop orders. Maybe you make an argument for buying above 73 because we bounced at that support and it was 2 legs down, but not ideal. You're buying on a stop pretty high in the trading range. And then limit orders today. A couple of dojis on the open, inside bar, buyers below, sellers above. We went outside up. You could probably sell the close of 3, but that's a scalp. And then bar 5, buyers below, sellers above. We went outside up. Probably sellers above 6, scaling in. And then through here, strong breakout, first pullback, probably going to fail, be minor. Sellers above 11, 12. And then I mentioned 16, bad stop order buy, so good limit order sell. You could sell above 16. Same goes for 19. You could argue parabolic wedge. Maybe you get a deeper pullback, but there's sellers above. Micro channel here, sellers above 27, but then buyers below 27 might be in a trading range. Micro channel here, sellers above, but they may not come in until somewhere higher because this is the middle of the range. And then a couple of legs up, probably sellers above this swing high, and low 1 below 42, you can buy below it. Tight trading range here, but low probability for a bear breakout. Low 1 below 53, you can buy below. Strong enough breakout here for a second leg up, you can buy below 59. Bad high 1 on 62, you could sell above it. Same goes for here. It's kind of like a fractal high 1, like on a higher time frame you'd see this, and you could sell above 64 with the same logic. It's 2 legs up, high in a range. Sellers above 64, you get triggered on 67. Couple of legs or a couple of bear bars on to 69, sellers above. Same logic, high 2, high in a range. You can sell above it. And then this is all sort of limit orders or buy the close, sell the close. You got a big bull bar testing resistance, you sell the close. Big bear bar testing support, buy the close, just back and forth. And if you're aggressive, maybe it's a wedge testing support, you can buy somewhere around the bar 60 close or low, get filled on 79. It's aggressive, but it's reasonable. And that will do it for limit orders. Where do we go tomorrow? Well, first let's look at the 5-minute and look at all the trading range price action going into the close. And so it was not really just sustained selling in a small pullback trend fashion. It was a big sell climax, and then sideways. And so it's more likely we go more sideways with sellers above this red line, this trading range, scaling in higher, and then probably buyers below this trading range. But because of the context on the daily chart, we have this extended bull trend with 3 legs up. A couple of ways to draw it. Maybe this, maybe here. It doesn't really matter either way. It's 3 legs up. And now you're getting an outside bear bar pretty far from the moving average. So there is a chance we just continue to go down to the downside and test the moving average. This is not above average bullish price action. And bulls are disappointed with what happened today, and they may look to exit longs, look to buy lower. And bears, they see 3 pushes up with an outside bear bar closing near its low, so they might sell below yesterday's low. But it is an outside bar, and we know just from looking at this chart that outside bars are expanding triangles, which are trading ranges. And then you look at the 5-minute, and there's a lot of trading range price action, probably buyers below. But all this momentum, there's an increased risk of the downside breakout. As always, please feel free to leave questions in the comments and leave timestamps with any questions specific to this video. And with that, I hope everyone has a good rest of their night. Thanks for watching.